Hello, and thank you for tuning in for the Benchmark Wealth second quarter market commentary. Despite the mixed results in the second quarter, by many measures, U.S. and global equities are off to a good start in 2024, building on the terrific performance from the final quarter of 2023. For example, the S&P 500 has turned in a gain of over 15% year to date, and the first 6 months are among the top 7 best starts that we've seen in the last 35 years. The themes that drove market performance in the second quarter continued to center around inflation, the Federal Reserve, housing market, mostly solid corporate earnings, and the labor market. In addition, recent inflation data, specifically the PCE index, which is the Federal Reserve's preferred measure of inflation, suggested that inflation might be finally waning, leading to Wall Street placing the odds of a September rate cut at around 50-50. Technological advancements, particularly in artificial intelligence, played a pivotal role in driving the equity markets, with tech-heavy indices in the United States and Asia recording significant gains. The excitement surrounding AI and its transformative potential was most evident in the surging valuations of mega-cap tech stocks, which saw superior gains. At the same time, sectors traditionally sensitive to economic cycles also experienced notable improvements as the global economy continued to recover from the COVID-19 pandemic. The so-called Magnificent Seven, NVIDIA, Microsoft, Apple, Google, Tesla, Meta, and Amazon delivered outsized gains averaging 39% and propelling the broader market upward. NVIDIA, in particular, stood out with a remarkable 150% increase, cementing its status as the world's largest company by market capitalization. Meanwhile, the looming presidential election added a layer of uncertainty to the markets as investors weighed the potential economic policies and regulatory changes that could arise from the new political landscape. This dynamic interplay between technological optimism and political anticipation shaped a highly eventful first half of the year for U.S. equities. Through mid-year, we've seen solid performances in sectors like information technology and communication services, driven by technological advancements and AI enthusiasm. Traditional sectors like financials and energy also saw gains due to economic recovery and higher commodity prices. However, real estate and materials faced headwinds from rising interest rates and volatile prices in the commodity space as well. Over the past few years, cash has served as a reliable security blanket for savers and conservative investors. The series of interest rate hikes from the Federal Reserve aimed initially to combat inflation and also provided higher returns on savings accounts, money market funds, and fixed income securities. As the odds of Fed rate cuts increase, it may be worth looking at shifting large cash positions to fixed income. Locking in longer-term yields today can be valuable as the yield curve normalizes in the years ahead and short-term yields come down. So, what's next for 2024? As we look forward, global stock markets have a strong fundamental foundation. However, investors should temper their expectations for a repeat of the impressive gains we saw in the first half of the year. With that said, there is a case to be made for additional upside, bolstered by the Fed and other global central banks easing restrictive measures, as well as anticipated corporate earnings growth. In the U.S., we remain focused on inflation and the labor market. There are some soft spots in the labor market, with the employment rate rising by 40 basis points on a 3-month average basis. Economic growth is normalizing from the red-hot pace of the past few quarters. Progress on inflation has been hit or miss at times, but has resumed in the most recent readings. We expect inflation to continue to get closer to the Fed target by the end of the year and move forward with 1 to 2 more rate cuts expected. The upcoming U.S. presidential election adds another variable that could have an impact on markets moving forward. In anticipation of continued uncertainty through the election cycle, we highly recommend investors have their portfolios properly rebalanced to fit their risk tolerance and long-term objectives. From all of us at Benchmark, we hope you enjoy the rest of your summer safely with your family. If you have any questions or would like to discuss our market outlook, please reach out following up to schedule a meeting with us. We look forward to talking with you soon. Thank you.